Shocking new data shows that U.S. companies slashed 32,000 jobs last month. This is now the worst drop since March of 2023. And manufacturing is seeing its seventh month straight of declines, suggesting even more layoffs are on the horizon. My friends, this is a nightmare scenario I've been worrying about. Plus, tonight's show is brought to you by Heritage Distilling Holding Company. You can find them on the NASDAQ symbol IPST. And they just launched IP strategy to revolutionize the IP landscape with a treasury of over 53 million IP tokens on the Story network. And here's the big news. The Story Foundation is going to buy $7 million worth of IPST stock on the open market, putting a floor under it and setting up for an explosive move higher. Stay tuned to the end of the show or check out the pinned comment or description for more information. Because when layoffs begin, it's going to affect every household all across the country. I'm going to show you how this started at the manufacturing level. It's now spilling over into the broad payroll report, why interest rates are going to come plunging down, and how the government shutdown could lead to localized recessions. Let's dive in because U.S. firms shed 32,000 jobs in ADP report after a data adjustment. And what this is indicating is everything I've been warning about the U.S. economy is the labor market is continuing to lose momentum. Now, the problem is at some point, layoffs are likely to spiral out of control. Let's take a look at this chart as companies in the U.S. reduced payrolls for a second straight month. And I want you to see very clearly that the slowdown in hiring started right around February. Now, why does this matter? Because it accelerated right around April into May and now has turned negative. But why does that April month matter? Because it's the same point. We saw the economic data start to roll over. Now what we're finding out is companies pull back on their hiring, and now they're starting to lay off as demand continues to fall. And the problem we're facing here is this is just going to cause a feedback loop. As more people lose their job, they're going to spend less money, and next thing you know, other people are going to see their hours get cut, and then eventually their job. And payrolls declined in industries such as leisure and hospitality, business services, and financial activities, as well as good producing sectors like construction and manufacturing. Now, I want you to think back to just a couple of months ago as we're coming into the end of summer. What did we hear from airlines? They said if things don't turn around, they were going to cut capacity, and I said that means we're going to see job cuts. Now we're finding out that leisure and hospitality slashing jobs just as the airlines warned. But it wasn't just them. You'll notice the manufacturing sector, and I've been talking about how when you start to see a slowdown in the economy, it's going to start first at the manufacturing level. We've been seeing this in the PMIs and the regional Fed surveys that's been showing us that a slowdown in the manufacturing sector is real. Of course, the problem we already know. They have way too much inventory, and there's not enough consumer demand to absorb all that inventory and keep the factories running. So as we see demand go down, you see capacity utilization in factories drop, and that's why this next chart is very clear in what it tells us is coming for the labor market. Let's take a look at this chart of capacity utilization. That's shown in blue against continued claims in red. And you can see very clearly as capacity utilization goes down, the demand for labor goes with it. You see continued claims rise. The risk we're facing right now is we're going to see continued decline in utilization. And that means, my friends, that claims are likely to go up and spiral out of control. But the declines were concentrated in businesses with less than 500 employees. And I've been warning about small employers. They just don't have the cash or access to credit to push through any slowdown in the economy. And if things were to get worse, they were going to start laying off because it's all about survival here. And that's the risk we're facing. We've seen a continued slowdown in retail sales to the point where it wasn't enough to move all the inventory. It wasn't enough to put enough money into these small business owners' pockets, and now they're laying off. And we can even see this spill over into the broad labor market as wage growth continued to gradually soften. Workers who changed jobs saw a 6.6% increase, while those who stayed put saw about a 4.5% gain. Little change from the previous month, which is why this next chart of average hourly earnings of production and non-supervisory employees versus continued claims matter, because as more workers hit the unemployment line, well, employers don't have to give big raises. Now let's take a quick look at the stock for our sponsor today show, IPST, because again, the Story Foundation is going to come in and buy $7 million worth of their shares in the open market. And you can see right now it's sitting on its 6-month volume profile, which is that red line going across your screen, and you can see there's been buying support every day that's dipped down, most likely from Story Foundation, and what this is doing is putting a floor under the stock and setting it up for a huge surge higher. Stay tuned to the end of the show or check out the pinned comment or description for more information. Let's take a look because you can see average hourly earnings of production and non-supervisor employees in blue, and you can see that decelerates as continued claims, still shown in red, heads higher, and we see that going into every recession. Now the problem is you can see the peak of average hourly earnings match the bottom of continued claims, and now what are we facing? A continued deceleration in average hourly earnings, suggesting once again that the continued claims data is going to go higher, and a question at this point isn't if we're headed to recession. The odds are actually saying we're in the beginning of one now. Let's turn to the manufacturing sector because, again, this is where I said everything was going to begin. As we look at the ISM, which says that manufacturing activity contracts now for the 7th straight month. Let's take a look at this table because this is really important. I want you to see that the PMI came in at 49.1. Now under 50, what that denotes is a contraction. Again, this is the 7th straight month. But look at this, new orders, which rebounded last month, well, they've turned negative again. And one thing I've mentioned, if new orders stay in negative territory, and more importantly, backlogs continue to get worked through, which now for the 36th straight month, we see a contraction in backlogs, what we're facing is a contraction in the labor market. We can now see for the 8th straight month, manufacturers noted that employment was in contraction. And something I want you to understand is a contraction in the employment part here doesn't necessarily mean layoffs. It can also mean cutting hours. But right now, the real numbers based on ADP are saying manufacturers are laying off. But there's another problem. Let's take a look because new export orders, they contracted for the 7th straight month. So you can see the effects of the trade war here are very real. Let's turn to Germany because look at this. Auto supplier ZF slashes a whopping 7,600 jobs in cost-cutting push. And again, we're seeing evidence from manufacturers all over the world that what we're facing is a slowdown in demand and way too much inventory in the system, and this means way too many employees as well. And as we lose these high-paying manufacturing jobs, I want you to understand the economy is going to lose their spending power, and the downward trend will continue until something changes. What that is or when it happens, I don't know, but based on all the historical data and parallels we have at this time, what we can see is as continued claims can move higher, they're going to spiral out of control, and next thing you know, we're going to be head first into a deep recession. And this is one of the reasons today we saw U.S. Treasury surge after ADP reports showed labor weakness, because as you lose the labor market, growth and inflation expectations will fall. And one of the key things is interest rates aren't a matter of who's buying treasuries, it's a function of growth and inflation expectations. What we saw was yields on 2-year notes, which closely track expected changes in monetary policy, moved 7 basis points lower to 3.54%, while 10-year treasuries also dipped. Let's take a look, and you can see very clearly on this chart of the federal funds rate in blue against 2-year treasury yields in red, and what this is very clearly telling the Fed loud and clear, hey, say, look, you need to cut rates. And not only are you going to cut rates, you're going to cut them again and again and again, because as the labor market goes, inflation becomes transitory, and next thing you know, again, you're head first right into a recession. And what we're facing here is the fact that rate cuts don't help those who are unemployed. They can't get a loan. And if they did get one, they're not going to go out and buy a bunch of stuff. They're going to use it to bridge until they get another job. So the problem right now is rate cuts, kind of our last line of defense against a recession. Well, you can see clear evidence. Not only they're not going to work, but the Fed is behind the curve. And further evidence as we turn to Lori Logan, she says the Fed should be cautious with more interest rate cuts. And Lori, what are you talking about? How can we be cautious here? The combination of persistent inflation, resilient demand, and modest labor market slack indicates to me that policy is likely only modestly restrictive. There may be relatively little room to make additional cuts. Now, Lori Logan is the president of the Dallas Fed. And just the other day, we talked about how ExxonMobil is laying off 2,000 people and how all these other oil companies have been laying people off. So, Lori, I don't get it. Can you not see what's going on in your own state? Because you're losing the energy market. We're seeing demand go away, and it's leading to massive layoffs, and you're seeing retail sales in your state crash, and all it's just going to do is lead to more layoffs. And all you can say is, you don't think we might get another rate cut? No, we're going to need a whole bunch of rate cuts, and by year end, you're going to be slashing rates like crazy. And this is one of the risks we're facing right now as we see a broad slowdown in the economy and the manufacturing sector, that the government shutdown, particularly if people get laid off here, will threaten to tip us right into an all-out recession. Because the U.S. begins the government shutdown with Trump, Democrats at impasse. As Trump has suggested, his administration would use a shutdown to conduct mass layoffs of federal workers beyond the temporary furloughs of an estimated 750,000 government employees. These job cuts would come on top of the roughly 150,000 workers leaving the federal workforce as of October 1st. So what we're facing here is a very serious impact. At a minimum, we could see localized recessions. But if you see mass layoffs from the government on top of this, the problem we're facing is the economy can't absorb these jobs. These layoffs are just the beginning of what's to come, because we're already hearing from U.S. consumers that they're pulling back on their spending. As they see the headlines of more layoffs coming, their spending is going to cut back even more. And that means for those that do have a job, their hours are going to get slashed, and then some people are going to lose their job. And next thing you know, this is going to continue to spiral out of control. So even though we don't have the official headline data for the non-farm payroll report on Friday, you can clearly see from the ADP data the labor market is contracting. This is validated by the ISM survey suggesting that manufacturing is laying off, and that's going to continue. And again, all we're seeing from the bond market is saying that growth and inflation expectations are coming down, meaning that all of these job cuts are only going to get worse. But something I'm bullish on is a stock for our sponsor for today's show, Heritage Distilling Holding Company. You can find it on the NASDAQ, the symbol IPST. And the bull case for this is the Story Foundation is going to come in the open market and buy $7 million worth of IPST stock. This is going to put a floor under it and could be the catalyst to send the stock price soaring. Let's take a deeper look, because I want to shine a light on IP Strategy, a company that's redefining how we think about ideas and inventions in the AI world. Formerly known as Heritage Distilling, they've rebranded and now trade under ticker IPST on the NASDAQ. As the first public company to hold a big chunk of its treasury in IP tokens, they're giving everyday folks a way to get in on the $80 trillion intellectual property economy, which is all about protecting and sharing ideas creatively. IP Strategy just announced a bold new plan to build up their savings in IP tokens, which power the Story network for making ideas programmable and safe for AI use. This is huge because AI companies are desperate for data they can use without legal headaches. They pulled in over $220 million from smart investors like Andreessen Horowitz, and they've added top advisors from places like Google to guide them. The CEO calls IP the gold of the AI era, opening up massive growth in this space. And right after they made a rebrand official with the IPST ticker, they got an overwhelming yes votes from shareholders at a 78% approval. They wrapped up a $224 million funding round, mixing cash and IP tokens, now worth about $731 million total in their holdings. The best part is they paid off all their old debts to start fresh with lower costs. The CEO says the company's true value, especially those IP tokens, isn't fully priced in yet, pointing to big upside as AI keeps booming. And here's more fuel for the fire. The Story Foundation, which backs the whole IP token ecosystem, just announced they'll buy up to $7 million worth of IPST shares right on the open market. And that's a strong vote of confidence from insiders who see the potential of this AI-powered IP world and sent the stock surging. Let's take a look at the stock chart, because you can see the bull case here. It's sitting right on a 6-month volume profile. That's that red line going across your screen, and you can see every day it dips down, there's buying support here. Highly likely it's the Story Foundation coming in and buying up those shares. Again, they're putting a floor under this, setting the stock up for a huge move higher. Altogether, IP Strategy smart pivot to IP tokens, backed by heavy hitters and cleared of debt, makes it a standout in the trillion-dollar rush for AI-ready ideas. It's raising eyes on how programmable IP could change everything. With moves like this, it's one to keep your radar on for the future. You can find it on the web at ipstrategy.co and on the NASDAQ under the symbol IPST. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades, and use risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.